Good day, everyone. Thank you so much for joining us today for our economic briefing. Today we're going to look at the GDP release as well as the Fed statement and the continuing claims. Overall, we know that GDP came out negative 32.9%, significant move down within our expectations. We expected it to be around 30% down. So we saw that come in. Consumer spending, which makes up about 68% of the economy, we see that was hit by negative 25.5%. So we saw that contribution the largest, and overall spending quarter over quarter decline was down 34.6%. Now, next quarter, for the third quarter, we anticipate that to recover somewhat, but not nearly to the level that it was at previously. Investment portion pulled off from that GDP 9.36%. That within there, that investment, both the residential and non-residential or business fixed investments did decline. Residential down 38.7% and the business investments down 27%. So two very large numbers, but that was expected with the shutdown of the economy, and we saw a lot of these businesses just not doing much investing. The question is, as we move forward, will we start to see that ramp up again? We have seen a pickup in the residential fixed investment. That's been a positive, and hopefully that will be sustained in here as we move forward. The government spending up 82, that's supporting that GDP positive 0.82 percentage points. However, the state spending did decline by 5.6%. So we did see that pull off in the state spending. However, on the federal side, that increased by 17.4%, which enabled the overall level to be a positive into the GDP growth by that 82 basis points. And then we had the net exports, imports contributing 68 basis points. So overall, the numbers came in right around where we expected them to. So it wasn't too much of a surprise. However, it is a very, very large number, that negative 32.9%. We look at the overall GDP per state, and we see for the most part every state negative for the second quarter. We did have a couple of states that did peak into the positive. Arizona, Utah, Idaho, they were able to pull off a positive or just slightly negative number. We had Idaho in there just around negative 0.05%. So that was kind of like a neutral item there. But all the other states saw that significant reduction in GDP in the second quarter. We saw that GDPNow on the 29th come out at that negative 32.1. So that was a good predictor in terms of where that actual GDP release came out at. And that's why we like to follow some of these items to give us some type of indication about where the numbers will come in. We look at the impact of the Treasury curve. Overall, the 10-year Treasury yesterday on the 29th was down to 58 basis points. This morning with the GDP release and with the continuing claims release, that came down another 4 basis points and most likely will continue that trajectory. So we can look at longer term, the rates remaining low and potentially going lower. We know that the expectation of inflation is very low. In here, we're at about 1.7, 1.65 on the five-year forward inflation expectation rate. So we continue to see just very low numbers here. We recouped where we were at the beginning part of the year, but still well below that 2% level, which we like to see. In terms of the Fed, we know the Fed came out very strong yesterday in terms of their viewpoint on the economy, and overall they continue to show that the outbreak has been tremendous on both human and economic. In a human economic sense, they continue to indicate that inflation will remain low in here, and that they will continue to support or try to get us back to price stability and full employment. We look at their overall level of rates, and they maintained that Fed funds rate at that 0 to 0.4%, which is what was expected. But they continue to say that they will support the credit of household and businesses over the coming months with an increase in their holdings of Treasury securities, of agency, residential, and commercial mortgage-backed securities, at least at its current pace, but most likely more. So they're going to continue to grow their balance sheet in order to help rates stay low across the yield curve, not just short-term rates, but long-term rates as well. And this is what we've been saying: prepare to be at these level of rates for a significant portion of time. We look back when the last time we were at zero rates, and we saw we were down there for 83 months. And we look at the Fed's projection that they came out in June, and that puts that Fed funds rate even out 3 years at that 0 to a quarter basis, a quarter percent. So this is our expectation, this is our projection, continuing to see low rates moving out well into the future. And we had that continuing claims come out. We know it came out slightly higher where it was last week. We were up to 17 million now. We picked up just a little bit, and we look, in history, you look back there with 17 million people filing or continuing to claim, and much higher than where we were back in the Great Recession, and much higher than we were historically. Even if you continue to trend this chart back, we're much higher. So that is a concern, particularly with the federal bump in that unemployment benefits, that $600 going away this week. So that's going to have a tremendous impact on our spending, on the consumer spending as we move through the third quarter, particularly if there's no continuation of that benefit. Even if it's not at that $600, if that fully goes away and there's nothing to replace that, we're going to have a significant impact to consumer spending moving forward. So that's what we have for you today. We look forward to talking to you next week when we're looking at the unemployment numbers that come out, as well as we look at how the community bank benchmark group has fared in the second quarter, and we'll look at our expectations in terms of net interest margin movements as we move through the next couple of quarters. Thank you for joining us. Have a great day, everyone.